Hey everybody, and welcome back to H Invests. Today we're going to go through the topic of inflation in full. I haven't seen that many videos covering actually what's happened in terms of inflation in the past couple of years. So today we're going to go ahead and do a full dive. We're going to work out how much of an inflationary crisis the US is actually in and how they're going to be able to solve it going forward. I hope you guys enjoyed the video. Right, quick disclaimer. This is all solely my own opinion. None of this is taken as financial advice, and content is solely for educational purposes. I'm referring to the US primarily in this video because it's the world's largest economy, biggest inflow of capital markets, most investor interest, etc., etc. But some of the themes that I'm talking about may or may not apply to situations in other countries. And also, I could have made an 8-hour video on this, and a lot of the information I'm sharing is going to be relatively condensed. So I'm not going to go into immense detail on everything that I could have done. I'm just going to try and get across as much of the key points as I can in under half an hour. All right, let's get into it. Okay, so let's start with the US core inflation rate. You can see that over the past 10 years, the Fed has done quite well with its mandate of keeping inflation stable, price stability, right? And you can see that it's traded in this bound between 0 and 3%. But post-pandemic, we've seen a very, very steep rise up to 7%. And a lot of people are trying to understand exactly the components as to what has caused this. So here we have a supply and demand curve, and if you don't know how these work exactly, look it up. But basically, what you need to know is supply has gone down and demand has gone up. So, and we're talking about supply for goods and services and demand for goods and services. So on the supply side, we've got bottlenecks, immense disruption to supply chains around the world. You've got lockdown measures also disrupting work. You know, people off work with COVID, off work because they've, been in contact with someone who's tested positive or whatever. And there's also been a labour shortage, which has been a component of this, which we're going to go through as well. On the demand side, obviously you've got lower rates going from 1.5% straight down to pretty much 0. And the base rate's been held at 0 for over 18 months. Excessive money printing, and also the stimulus. The money printing, the QE, and the stimulus were two different things, and we're going to go through both of them. So, long story short, you've got demand here, which has shifted upwards, and then you've got supply here, which has shifted back. So for a given quantity of goods, they're at a much higher price. That's what this diagram is depicting. Much higher supply, much lower demand, and thus higher prices at a given quantity. You've got more and more money chasing less goods and services, therefore the price of the goods and services go up and the purchasing power of the money goes down. Right, so let's start with the demand side. We're going to start with the money printing. So the Federal Reserve's balance sheet has doubled from pre-pandemic levels. This was to inject the market with liquidity when we had the COVID pandemic. So effectively the Fed saved the market, right? You look at the stock market and how it absolutely was crashing in March 2020. The Fed injected a load of liquidity into that market and it sent the market shooting back up again. So they do that by buying instruments such as bonds, mortgage-backed securities. Obviously that then goes into the open market where there are a load of investors, and then there's all this excess liquidity in the investment space, and then houses and stocks and bonds get bought up, and yeah, it basically drives the market back up. So that is one side of the inflationary picture, but it's more to do with the inflation in asset prices. I mean, some people, they will sell the gain of that asset prices, and then that money gets released into the wider economy. But the QE is more that side of inflation. But coupled with that side, the money printing, oh yeah, this is what I was saying a minute ago, mainly flows into financial institutions. They buy assets. This is the other side of the equation. These financial institutions, many of them banks, obviously they're injected with a load of liquidity, right? and that liquidity can be cheap borrowing, which then stimulates the economy. People can get more leveraged on their financial position, and therefore they can spend more for each given amount of income that they make because they're more leveraged. Yeah, so we've been through that. That's the federal funds rate I was talking about earlier. So you can see the hikes, but then they reversed it in 2019. Here is at the 1.5. And then they cut again, 0.25% base rate, and we've been there ever since. So this is the other side of the demand, is the stimulus, which is completely different from QE. And a lot of people that are relatively new to the financial investing space, they don't actually realize they're two completely different things. So we had a stimulus before in the global financial crisis, and that came to 152 billion in 2008. And then when the crisis got really bad in terms of affecting the actual, economy and people's lives, things like unemployment, then there was another 831 billion stimulus package. So we're talking just shy of $1 trillion in stimulus in the GFC. But in March 2020, Trump passed the CARES Act, and that was 2.2 trillion of stimulus, right? So you've got direct payments for individuals, unemployment benefits, assist states and localities, small business loans, a load of liquidity again, but this was much more direct liquidity. It helped out much less the big banks and people that own the financial assets, and much more the average American citizen. So one example, all American citizens earning less than $75,000 a year received a $1,200 stimulus check regardless of their circumstance. So that was the first one. Now, we had another one I think it was in March of 2021, which was Biden's one. So that was another 1.9 trillion of stimulus. And you can see a lot of it consisted of stimulus checks and pretty much the same kinds of things. Now, this level of stimulus package is absolutely immense. I'm not here to debate whether it was right or wrong, or whether they got the level right or wrong. But I just want to highlight it is a very, very significant level. So we're talking of literally this was over a 12-month period, right? Because it was from March 2020 to March 2021, a $4.1 trillion stimulus package overall, which is the equivalent to the GDP of Germany, the fourth largest economy of the world. That's twice the GDP of Canada. Or each one of these were basically the GDP of Canada, which is the ninth largest economy in the world, right? Over 30 million people. And a country with very high living standards. So these stimulus packages, which were much more direct, it produced an absolute insane amount of liquidity in the market. And of course, this pushed people's disposable incomes higher. You can see March 2020's Trump stimulus, there's the spike. And then the Biden stimulus actually caused an even bigger spike. And what you can see is if we put a trend line on this graph, because you can see that people's disposable income, it's pretty slow and steady uptrend over time. We're looking obviously post the GFC, so you've got relatively stable macroeconomic conditions from 2014 to 2020. And you can see this pretty slow, steady growth. So we plot this line of best fit from 2014 to the start of the pandemic. You can see as that line of best fit goes on, we remained far above it. So the stimulus not only supported people that were losing their jobs and declined disposable income, and actually overdid it. So people would have had more liquidity. They did have more liquidity, from these stimulus checks, despite some people being unemployed. Then if COVID hadn't happened, the stimulus checks hadn't happened, we'd probably be, under the $18,000 mark as opposed to over the $18,000 mark. And of course, what this has done is it's pushed spending up, right? So here's the Redbrook Index, and that measures year-on-year sales growth in the US across a variety of sectors. In the kind of the large stores, it represents 9,000. And what you can see is usually the turnover in terms of this sales growth is somewhere between like 0 and 8%, depending on the macroeconomic conditions. But obviously it dropped in COVID. People were very anxious and they were saving money for a little bit. And then as this stimulus kept coming, as the market started to recover, as we got vaccines, as people realized, okay, COVID could have been much more serious than it actually turned out to be, people started spending much more. And you can see that this spending, it wasn't below zero for that long. but then it got above zero, and now, you know, we've actually been between 50 to 20% year-on-year sales growth for quite a long time. So you can see spending has massively increased. And if we take a look at the next chart, this is from the Creds, from the US Census Bureau, we're looking at advanced retail sales. Again, we saw a dip in the initial pandemic, stimulus checks came in, and then retail sales came up, and they've been climbing and climbing ever since. If we calculate from Feb 2020 at 460 billion, and then December 2021 at just over 550 billion, we see a 21% increase in retail sales in less than 2 years, caused by mainly stimulus money. Because obviously if this stimulus money hadn't have happened, we would have seen that effect on the economy, and we would have seen, you know, more people being unemployed and less spending. But instead, we saw the opposite effect, and that's a significant increase in spending, particularly considering, look at how flat this line is between 2017 and 2020, and then boom, wham, we see this very big growth. Again, if we had have drawn the trend line, we would probably be, what, somewhere about here right now, much lower than where we are now from the stimulus money. And quick cause and effects. What's this caused? A massive budget deficit. So I know that says budget surplus on that graph, but in fact the US hasn't been in much of a budget surplus. Well, it just about got to a budget surplus before 9/11, and then spending went up to, you know, fund the Iraq war, and we have basically been in a deficit ever since. So you can see the dramatic effect. We were at about a 15% budget deficit in 2020, and this CARES Act, 2.2 trillion, that was the initial one, and the US GDP in 2020 was about 21 trillion. So this CARES Stimulus Act, this money that went straight into you know, people's pockets for support and relief, that ended up in excess spending, was 10% of the entire GDP. Massively significant. So this stimulus package caused the US government to run a 10% higher budget deficit than it otherwise would. Again, I'm trying not to comment on, you know, what optimal levels, how much I think this is good, how much I think this is bad. I'm just showing you the inflationary effect of what the stimulus package has caused. And here's the US debt to GDP. So you can see that post GFC, once we recovered from it, the US was pretty stable at about 100% debt to GDP. And then because they had to take on a load more debt, which they could do at the low interest rates, because that was the other thing that happened, is that the Fed massively cut the interest rate, then the debt to GDP skyrocketed to 128%. Okay, so US dollars in circulation, money supply. So I'm using M2 for this as a broad measure of US dollars in circulation. So that's all coins and notes, which I think is M0. Other money equivalents that can easily be converted into cash. So those first two are M1. And then we've also got short-term deposits in banks and some money market funds. So basically, the deposits and the money market funds are very liquid. They can easily be turned into cash and spent. So we're looking at, yeah, all of that money supply. And you can see, again, we've got this slow and steady growth of the money supply post GFC to 2020, and then a sharp increase and a steep increase, yeah, and basically ever since then. So we've got more and more dollars in circulation. That's what this is showing us. Currently 22 trillion US dollars in circulation. Before the pandemic, it was only about 15 and a bit dollars in circulation. Here's the exact figure. So it's 15.3 in December 2019, 21.6 in December 2021. So that's actually an increase, I think, of about 37 or 38%, but it's 18.8% annualized, which is absolutely insane. And I think that pre-pandemic, annualized, it was about 5%. We went from 10,000 in 2012 to 20,000, sorry, to 15,000 at the end of 2019. That's about a 5% annualized increase. Since the pandemic, we've seen an 18.8% annualized increase in the amount of US dollars in liquid circulation. Right, so that's demand. You can see that demand has basically increased because the market was flooded with liquidity, both in terms of the asset purchases and the stimulus. And yeah, that's created more and more demand, so you've got more and more dollars. But also there's a supply issue. This is a double whammy. You've got more and more dollars, but they're actually chasing less goods. So we've gone from this S to the S with the dash. and that is causing prices to rise. So we're going to have a quick look at the supply side now, and I'm sure you guys have heard about this. Massive supply chain issues across the world, and in fact the World Trade Organization chief is warning of continued bottlenecks. That was in the news recently. So you've got a few things going on here. You've got the underestimation of sharp demand rebound. So basically what happened was, when the pandemic came, obviously a lot of countries went into lockdown, which slowed production, but also they stopped producing because, at least temporarily, a lot of sectors that demanded these goods and these commodities, they were like, nope, the economy is going to shut down from a consumer standpoint. But then what happened is, like, after a couple of months, stimulus came in, you know, people were more and more confident about economic recovery, and the demand didn't slow down, but the supply then couldn't keep up. So then we had these massive bottlenecks, and of course, like, productivity and labor are also down from COVID restrictions and people isolating. And yeah, now there's a massive backlog in terms of shipping. So there's, you know, less and less supply, which is causing prices to rise. So just wanted to show you a few examples of price rises in commodities. This is absolutely insane. So this is aluminium for all my British viewers, my aluminum for all my US viewers. And yeah, you can see dramatic price increases in aluminium. And I picked aluminium because you know, it's a very big component of, you know, raw commodity production. A lot of different things contain aluminium, and you can see an absolutely insane increase in the price. Here's another example: wheat, you know, bread and butter of a lot of people's diets, quite literally, you know, with bread and other carbohydrates, etc. You can see sharp increases in wheat prices. What have we got here? So pre-pandemic, we're at about 550. Now we're approaching 800, and actually went over 800 a couple of months ago. Here's another example: coal has absolutely ballooned from 75 US dollars per ton pre-pandemic. Now we're over 200. It's just absolutely insane, the commodity price increases. And of course, like, this is where it all starts. You know, raw commodities increase in price, and that causes, you know, refining and making products increase in price, and then that moves on to wholesalers, moves on to retailers, moves on to the consumer, and it all goes in a big cycle. Yeah, so here's some more general ones. This is in the agricultural sector, and this is just year-on-year price increases, this column here. So you can see most of them are up, and a lot of them are up, you know, by north of 25%, which is where it gets scary up. But actually this, you know, if I'd have shown it in the past 2 years from pre-COVID, it would have actually been much worse. You can see a lot of these commodities that had their sharpest increase in 2020, and now they're sustaining that high levels, but most of these commodities are actually growing in price even more into 2021, which is really scary. Like, oats have doubled in price in the last year, coffee. It's across the board. You know, if I show you again, like, some of these industrial metals and gas, you can see there's been absolutely insane price increases pretty much unanimously across the board. And this, as I said, this is causing, eventually going to go down the system: production, wholesale, retail, consumer, and these costs will ultimately be passed on, and businesses will have to reduce their margins in certain areas to compensate for this as well, because this is insane price increases caused by supply constraints, and of course that increase in demand that we've seen through money printing and stimulus checks, and basically everything being loaded up on excess debt. You can see the pressure hitting companies in the news. These, I think, are all from Q4. McDonald's hit by inflation. Tractor Supply, you know, they supply a lot of kind of general outdoorsy goods and services in the US. General Electric, Iron Brew, is raising prices. That's a UK-based beverage company owned by AG Bar, as prices soar. So you can see it across the board. I mean, you only have to look at companies' Q4 results. You know, put Control F into inflation, put inflation in using Control F, and you can see massive concerns in many different companies. Right, this is another massive problem that's contributing to inflation. Is you can see that there have been the most job vacancies in the US in the past 20 years. We've seen massive job vacancy increases from about 7 million pre-pandemic to 11 million is where we're at today. Very sharp increase, which is very interesting, and there's a number of reasons for this. you've got more and more people quitting their jobs. And again, there's a variety of factors for this, but people are leaving, and then there's vacancies, and companies are trying to fulfill them. There's many different kind of suggestions to this whole culture. I'm sure you guys have seen it in the news in the past couple of months, but people are not wanting to go back to their job. People are changing jobs a lot. I think working from home has been a big part of it, where people have seen the benefits of working from home and they've enjoyed that lifestyle, and then coming back in the office, they don't want to do that. The stimulus checks, I think, have played a factor. People not working and then having to go back to work, I think has been difficult for some people. Changes from COVID, so when we had the first lockdown, it shut the whole world down. It made the whole world as a more relaxed change of pace. People rethinking their priorities. I'm going to say it's politically incorrect, but I think some people have been brainwashed into being perpetually terrified of COVID. Of course, with all the media hysteria we've seen over the past couple of years, I think that there are some people that just don't want to go back to working in a physical environment, even if their job requires it. And then on the other side, some people don't want to put up with the COVID restrictions, wearing masks for 8 hours a day plus. Again, understand all of these concerns. They're different for every person, but the actual facts are showing us that people quitting their jobs is up significantly. I think that all of these reasons are contributing to that in one way or the other. And of course, what have companies had to do in order to try and fill these vacancies and try and stop people quitting? Wage growth. Yep, so again, from our good old friends, the Creds, wages are growing at the fastest pace in 20 years. And there's a massive, massive problem with this. So this is where we get away from the transitory narrative. Wages are very, very sticky. It's very, very hard to bring wages down again, particularly when there's so many vacancies, right? More people are still quitting their jobs, right? This trend has been massively upward in the past year. How are you going to say, right, your annual salary has gone from $50,000 to $55,000? You can't then bring that back to $50,000, right? And because you've got more and more companies competing to hire people, they're just raising wages to try and outcompete, try and get the person employed, and it's just causing this spiral of wages going up. That's why we've seen the fastest wage increases in 20 years. And there's big problems with that because, as I said, wages are sticky. It's hard to bring wages back down. This then gives people more dollars to spend, which then pushes demand up, which then pushes prices up, and it causes inflation to keep going and keep going. Right, so what is the Fed's current course of action to slow all this down and solve all of this? Well, the Fed finally admits that inflation wasn't transitory about 2 months prior to this video being filmed, so end of November, which is absolutely mind-boggling. It makes you think, okay, were they saying it was transitory deliberately to not prick this ridiculous asset bubble that we've got going on? Maybe, potentially. But long story short, now, all of a sudden, they're considering a rate hike in March, and even them talking about considering a rate hike in March has been enough to prick the stock market bubble. We've seen the Nasdaq had its worst month on record since October 2008, being down 9%, and that's absolutely crazy for the market to be that sensitive and to be that leveraged for just a hint that we're increasing rates, and base rates are at 0.25%. Just a hint that we're increasing it to 0.5%. For that to pop the market, or to really start popping the market, is absolutely crazy. So Goldman Sachs, this was in the news I think a couple of days ago. They've increased their baseline estimate to 4 to 5 rate hikes. Bank of America is expecting 7. So all of a sudden, the market is pricing in these rate hikes, and that's where we've seen equity markets fall. What's nuts about this is the Fed is still creating money. So in November, they started this 120 billion monthly bond buying program after the initial liquidity injection. This is the initial liquidity injection. You've got a couple of $1 trillion there just being created out of thin air, about 10% of US GDP annually just created out of thin air. And then about 120 billion of bond buying every single month. And they were still doing that in November of 2021. So the Fed is still buying 60 billion. They bought 60 billion of bonds this month. In November, they started tapering, so it was 120 billion in November, 90 billion in December, and then 60 billion in January. And they are yet to announce any further reductions, but I'm assuming that reduction will keep coming, and then they will basically hike up the rates. So this is the relationship between the federal funds rate and inflation. And this is actually lower than CPI inflation because it's excluding food and energy. And I've always thought this is a bit bizarre. The only reason I'm including this type of graph is that the pattern is roughly the same. This red one is a bit lower. And it was just the Creds website being a bit annoying that like I couldn't include core CPI and the federal funds rate on this kind of graph. I just had a bit of trouble with the technical issues. But anyhow, this shows the rough pattern. I think that CPI should include food and energy. Because, you know, when you look at people's main core living expenses, once you discount living costs, like actual housing costs and taxes, it is food and energy. You know, it's a considerable part of people's consumption. But anyway, so you can see here that historically the base rate has always been above the inflation rate, and in the 1970s, you know, when this inflation rate started to take off and get above the interest rate had to be hiked massively. That then caused a recession, brought the inflation rate down. That's basically what popped it. But we're in such a unique situation today where the differential between the red line and the blue line is so big, with the red line being on top. So now we've got, you know, inflation rates up at 7%. We've got the base rate down at 0.25%. So that real interest rate on the base rate is about minus 6.75%, which is really, really bizarre. So what I'm trying to say is I don't think that these tiny little rate hikes in themselves will be enough to pop this inflationary bubble, particularly with all the pressures we're seeing from a labour market, the injection of liquidity. We've got the wages still rising, and the supply constraints still going on. We're still seeing that, you know, companies saying there's this massive bottleneck and it's being a nightmare to solve. That's going to be a massive, massive problem. But it's interesting to see that just the talk of inflation has instilled fear into the economy, and we may actually see credit tightening considerably, even though the Fed actually hasn't raised the base rate yet. It's going to be very, very interesting to see what happens. Maybe that was all part of their plan. I do find it hard to believe, looking at all this economic data, that the Fed really thought inflation was transitory until November, but we will see. The labour shortage, the job quitting, and the fact that wage growth is the highest that it's been, at least in nominal terms, for 20 years, is probably one of my bigger causes of concern when it comes to this inflation not being transitory, because of how sticky wage inflation is and the fact that you can't bring it back down. Right, so in conclusion, inflation problems persist. We've got supply down with bottlenecks, lockdown measures, disrupting work, and labour shortages. You've got demand up with, you know, rates to the floor. You've got excessive money printing and stimulus, which injected a load of liquidity into the economy. People bought more, that increased prices. Sharp increases in spending, sharp increases in wages. And always remember the graphs of those commodity prices. It's absolutely insane compared to what it was before the pandemic. Costs of commodities are up across the board. That's ultimately going to go through and through the supply chain, and that cost will be ultimately passed on to consumers, causing end prices to rise even further. I don't want to leave you guys all on a cliffhanger and you're thinking, oh my goodness, you know, put your money where your mouth is with regards to this inflation. So I'm saying yes, the inflation is not transitory. I think it's going to be here for a long time, and I'm going to release a video very, very soon giving you guys a very quick overview as to how my portfolio is looking and how it is taking into account what's going on with inflation. You know, how am I adapting my portfolio to protect my assets going forward with regards to this high inflation environment. I hope you guys enjoyed the video. I'm just trying to give you guys the best picture that I can. I hope you enjoyed the video. Please leave any questions down in the comments. Good luck with your investing, and I'll see you guys next time.